In Canadian personal finance, savers usually face a strict either-or decision. You either get a tax break today when you put your money away, or you get tax-free money tomorrow when you take it out. This diagram shows how the RRSP works. Contributions bypass the tax barrier going in, but hit a tax barrier upon withdrawal. The tax-free savings account operates in reverse. Money hits a tax barrier before entering, but comes out completely tax-free on the other side. Both of these accounts are highly effective for general investing, but for someone facing the specific, massive financial hurdle of buying their first home, neither structure offers a completely friction-free path to save. That changes with the First Home Savings Account, introduced in 2023. The FHSA takes the defining feature of both earlier accounts and combines them. You get an RRSP-style deduction on the way in and a TFSA-style tax-free withdrawal on the way out. By successfully shielding the money on both entry and exit, the FHSA effectively eliminates taxation across the entire lifespan of those savings, offering an unmatched mathematical advantage for eligible first-time homebuyers. This chart outlines the precise participation limits of the account. In the first year you open an FHSA, you receive $8,000 in contribution room. You gain another $8,000 in room each subsequent year until you reach a strict lifetime contribution limit of $40,000. If you cannot contribute the full $8,000 in a given year, your unused room carries forward. This allows you to partially catch up on missed contributions in future years, up to an annual maximum. Contributions made within these exact limits are generally tax deductible. Every dollar you contribute directly reduces your taxable income for that calendar year, which lowers your total tax bill. To see how that deduction impacts your wallet, look at this illustration. Keep in mind, this is an assumption-based example, relying on a flat 40% marginal tax rate, not a guarantee of your specific return. Under that 40% tax rate assumption, maximizing your $8,000 FHSA contribution for the year would reduce your immediate tax bill by roughly $3,200. The actual dollar amount you save will depend entirely on your own personal tax bracket. When it is time to buy or build your qualifying first home, you make a qualifying withdrawal. The entirety of those funds comes out tax-free. That includes your original contributions, plus any investment growth generated inside the account over the years. You retain the upfront tax return granted by the government, and you capture years of compound investment growth that the government cannot tax. The primary hesitation most people have with a dedicated savings vehicle is the fear of stranded capital. Life is unpredictable. You might plan to buy a home today, but your circumstances could easily change, leaving you with tens of thousands of dollars locked in an account you no longer need. The government anticipated this. The FHSA includes a designated transfer mechanism, allowing you to move your funds directly into an RRSP or a RIF if you never purchase a qualifying home. Watch the capacity meter in this diagram. When you make that designated transfer, the money shifts seamlessly into your retirement pool. The transfer is not included in your income for the year, and most importantly, it does not use up a single dollar of your existing RRSP deduction room. Any unused FHSA funds effectively transform into bonus retirement savings. They stack cleanly on top of your normal lifetime RRSP limits. Because of this risk-free transition into your retirement strategy, there is almost zero financial downside for an eligible Canadian to open the account. The structure is highly advantageous, but the government tightly controls how long you can use it. This timeline shows the account's 3 mandatory expiration triggers. You must close your FHSA by the end of the year you turn 71, or exactly 15 years after you open it, or the year following your first qualifying withdrawal, whichever of those 3 events happens first. However, the most critical constraint isn't about when the account closes. It is about how the participation room is generated in the first place. Contribution room does not accrue automatically simply because you reach the age of majority and are eligible. The clock remains frozen at 0 until the year you formally open an FHSA. Only then does your $8,000 of room unlock. Every year an eligible Canadian delays opening the account is a year of potential participation room that they do not get to build. The unused room carries forward, and the RRSP transfer protects your capital if your plans change. The only true mistake is waiting. You cannot capture the compound growth or utilize the tax savings if you haven't opened the account to start the clock.